There's always a good reason why people anchor. Experiences that have been enjoyable in the past are always sought after into the future. Sometimes, though, you have to be alert to conditions changing around you. So to the extent that we've had a very buoyant period of credit creation in Australia and a very benign environment of bad debts, it's led to a wonderful experience for bank equity holders. That's unlikely to be able to be repeated in the future to the same extent. In fact, it's impossible that'll be repeated to the same extent through the next decade. It doesn't mean that they're catastrophic. It does mean that diversifying away from what has been the silver bullet of return with low risk on the Australian equity market through the next 5 to 10 years is probably an eminently sensible idea. It doesn't mean in doing that that you're likely to have to sacrifice any real return. It is likely in doing it that you're buying quite a degree of risk protection at a moderate price. Risk at a fundamental level is simply a function of the gearing embedded in a company, but also its operating earnings in the future. The bank levy we've seen recently is arguably an example where risk is accrued to equity holders where they weren't expecting it. On the one hand, pricing power was evidenced through the banks putting up mortgage rates continuously. On the other hand, arguably left the door open for a political response where the extra profit that was obtained through increasing prices of mortgages has now been taken back by the government as a levy. Oftentimes risk emerges where you don't expect it and probably when you're most complacent. The fact that the environment's been quite strong for the last couple of decades shouldn't be mistaken for complacency about what's likely to emerge in the future. People often criticise BHP for being arrogant because of its position and its dominance in an industry and for wasting the proceeds of the cash flows from those privileged assets. It's a great example where being big in itself can sometimes be a disadvantage and not an advantage and necessarily accrue to equity holders into the future any ongoing benefit. In fact, there's a good argument to be made, and Woolworths is a classic case study of this through the last 5 years, that by far the hardest thing for companies to do, whether they're big or small, is to focus on being good rather than being big. And that most return accrues to equity holders when companies best execute upon a goal of being good rather than being big.